I bet you didn't know that you could make consistent profits in the crypto market without predicting its direction. In the fast-paced world of cryptocurrency, opportunities for profit seem to emerge at every turn. The digital landscape is ever-changing, with new coins and tokens being introduced regularly, and market conditions shifting rapidly. Amidst the volatility and uncertainty, savvy traders seek strategies to capitalize on market inefficiencies. They are constantly on the lookout for patterns and anomalies that can be exploited for financial gain. One such strategy, triangular crypto arbitrage, has gained significant traction, promising the potential for substantial returns. This method leverages the inherent discrepancies in cryptocurrency prices across different exchanges. Like a well-choreographed dance, triangular arbitrage involves exploiting price discrepancies between three different cryptocurrencies across multiple exchanges. It requires a keen eye and quick reflexes to identify and act on these opportunities. This intricate dance of buying low and selling high, executed with precision and speed, can unlock a world of profit for those who dare to master its steps. The key is to move swiftly and decisively, as the window of opportunity can be fleeting. Imagine a scenario where Bitcoin trades at a slightly lower price on exchange A compared to exchange B. This small difference can be the starting point for a profitable arbitrage sequence. Simultaneously, Ethereum's price on exchange B is lower than on exchange C. These price variations create a chain of opportunities that can be linked together for profit. A cunning arbitrageur recognizing this opportunity can purchase Bitcoin on exchange A, transfer it to exchange B to sell at a higher price, then use the proceeds to buy Ethereum on exchange B and immediately sell it on exchange C for a profit. This sequence of trades, if executed correctly, can yield significant returns. This seemingly complex maneuver, when executed swiftly and efficiently, can generate significant gains, making triangular crypto arbitrage an alluring prospect for traders seeking to maximize their profits in the ever-evolving cryptocurrency market. The potential for profit is substantial, but so is the need for precision and speed. The allure of triangular crypto arbitrage lies in its potential for consistent profits regardless of market direction. It offers a way to make money without having to predict the overall market trend. Unlike traditional trading strategies that rely on predicting market movements, arbitrage exploits existing price discrepancies, offering a more predictable path to profitability. This predictability is what makes it so attractive to many traders. However, this enticing opportunity comes with its own set of challenges and risks. The market's volatility can work against you just as easily as it can work in your favor. The cryptocurrency market, known for its volatility and rapid price fluctuations, demands speed, precision, and a deep understanding of market dynamics to succeed in triangular arbitrage. Traders must be prepared to act quickly and decisively. This essay delves into the intricacies of triangular crypto arbitrage, unraveling its complexities and equipping aspiring arbitrageurs with the knowledge and strategies needed to navigate this potentially lucrative, yet challenging trading strategy. We will break down the process step by step to make it accessible to both novice and experienced traders. We will explore the fundamental concepts of cryptocurrency and trading, providing a solid foundation for understanding how arbitrage works. Delve into the specifics of triangular arbitrage, examine real-world examples, and highlight the nuances that can make or break a trade, and discuss the challenges and risks involved. Understanding these risks is crucial for anyone looking to engage in this type of trading. Furthermore, we will provide practical solutions, strategies, and tools to enhance your arbitrage game and mitigate potential risks. These tools can help you stay ahead of the competition and make more informed trading decisions. So, fasten your seatbelts and prepare to embark on an exciting journey into the world of triangular crypto arbitrage. This adventure promises to be both educational and potentially profitable, offering insights that can transform your trading approach. Before we dive into the intricacies of triangular crypto arbitrage, it's crucial to grasp the fundamentals of cryptocurrency and trading. Understanding these basics will provide a solid foundation for more advanced strategies. Cryptocurrencies like Bitcoin and Ethereum are digital or virtual currencies secured by cryptography, making them nearly impossible to counterfeit or double spend. These digital assets have revolutionized the financial landscape, offering new opportunities for investment and innovation. These decentralized currencies operate independently of central banks and governments, relying on a distributed ledger technology called blockchain to record and verify transactions. This independence is one of the key features that attract many to the world of cryptocurrencies. The blockchain, a revolutionary technology, serves as a public, transparent, and immutable record of all transactions. Each block in the chain contains a list of transactions, and once added, it cannot be altered, ensuring the integrity and security of the data. Imagine a digital ledger replicated across a network of computers, where each block represents a group of transactions added to the blockchain. This decentralized approach ensures that no single entity has control over the entire network, enhancing security and trust. This decentralized and secure nature of cryptocurrencies has fueled their rapid adoption, attracting investors and traders alike. The potential for high returns and the innovative technology behind these digital assets have made them a popular choice for many. Trading cryptocurrencies involves speculating on their price movements, aiming to buy low and sell high. This speculative nature can lead to significant profits, but it also comes with substantial risks. Cryptocurrency exchanges, online platforms that facilitate the buying and selling of these digital assets, play a crucial role in this ecosystem. They provide the necessary infrastructure for traders to execute their strategies and manage their investments. These exchanges connect buyers and sellers, providing a marketplace where traders can execute their arbitrage strategies. The liquidity and variety of trading pairs available on these platforms are essential for successful trading. Understanding the basics of cryptocurrency and trading is paramount before venturing into the world of triangular crypto arbitrage. A strong grasp of these concepts will help you navigate the complexities of the market and make informed decisions. A solid foundation in these fundamental concepts will empower you to navigate the complexities of this trading strategy and make informed decisions. Continuous learning and staying updated with market trends are crucial for success in this fast-paced environment. As we delve deeper into the specifics of triangular arbitrage, remember that a thorough understanding of the underlying technology and market dynamics is essential for success. This knowledge will enable you to identify opportunities and execute your strategies effectively. Arbitrage, a fundamental concept in finance, involves exploiting price differences of an asset or commodity between two or more markets. This practice has been around for centuries and remains a cornerstone of trading strategies. This strategy capitalizes on market inefficiencies, where the same asset is priced differently in different locations or exchanges. These inefficiencies can arise from various factors, including supply and demand imbalances, regulatory differences, or even time zone variations. Arbitrageurs, the savvy traders who engage in this practice, profit from these discrepancies by simultaneously buying low and selling high. Their actions help to bring prices back into equilibrium, benefiting the overall market. Imagine walking into one grocery store and finding a pound of apples for $1, while another store across the street sells the same apples for $2. This price difference presents a clear opportunity for profit. An arbitrageur, recognizing this price difference, would buy all the apples from the cheaper store and immediately sell them at the more expensive one, pocketing a tidy profit. This simple example illustrates the essence of arbitrage, exploiting price discrepancies for financial gain. This simple example illustrates the essence of arbitrage, exploiting price discrepancies for financial gain. However, in the real world, the process is often more complex and requires sophisticated tools and strategies. In the context of cryptocurrency, arbitrage opportunities arise due to various factors, including market volatility, liquidity differences between exchanges, and the decentralized nature of these digital assets, and delays in information dissemination. News and events can cause rapid price changes, creating short-lived opportunities for those who are quick to act. As cryptocurrency markets operate 24/7 across numerous exchanges globally, price discrepancies are inevitable. The constant trading activity and varying levels of participation across different time zones contribute to these differences. These discrepancies, however small, present arbitrage opportunities for vigilant traders. Even a slight difference in price can be profitable when leveraged correctly. While the concept of arbitrage is relatively straightforward, its execution requires speed, precision, and a keen eye for market inefficiencies. Traders must be able to act quickly to take advantage of fleeting opportunities. Identifying and capitalizing on these price differences before they disappear is crucial for successful arbitrage. This often involves using advanced algorithms and trading bots to monitor and execute trades in real time. As we delve into the specific case of triangular crypto arbitrage, remember that understanding the core principle of exploiting price discrepancies is fundamental to mastering this trading strategy. By grasping the basics, you can better navigate the complexities of the market and enhance your trading success. Triangular arbitrage, a specialized form of arbitrage, focuses on exploiting price discrepancies between three different assets, typically cryptocurrencies, across multiple exchanges. Unlike traditional arbitrage involving two assets, triangular arbitrage introduces an additional layer of complexity and opportunity. Imagine a triangle, with each point representing a different cryptocurrency on a separate exchange. The arbitrageur, spotting a price discrepancy between these three cryptocurrencies, initiates a series of trades, moving funds through each point of the triangle to exploit the price differences and ultimately end up with a profit. Let's illustrate this with an example. Suppose exchange A offers a favorable Bitcoin to Ethereum exchange rate, while exchange B provides a better Ethereum to Litecoin rate, and exchange C presents an advantageous Litecoin to Bitcoin rate. A triangular arbitrageur, recognizing this opportunity, would initiate a trade by purchasing Bitcoin on exchange A, converting it to Ethereum, then transferring the Ethereum to exchange B to exchange for Litecoin. Finally, the Litecoin would be moved to exchange C and traded back to Bitcoin, completing the triangular arbitrage and ideally resulting in a profit. Triangular arbitrage, while seemingly complex, capitalizes on the interconnected nature of cryptocurrency markets. By leveraging price discrepancies between three assets across multiple exchanges, traders can potentially generate significant profits. However, this strategy demands a deep understanding of market dynamics, swift execution, and a keen eye for identifying profitable opportunities.